We have the inflation numbers that have come out on your screen. What do we have? 6.8%. Okay, so that may be taken in as a bit of a disappointment, given that we were expecting a 6.5% number according to the ET Now poll. Now remember, the top end of the range had indicated a number of 6.8%, so that was the worst case scenario that we were factoring in with a 6.2% as the best case scenario. I don't know how much the markets will digest this as a disappointment, but Samaran Chakrabarti, a Standard Chartered, is standing by. Samaran, how would you react to 6.8%?
Well, it's slightly higher than our own expectations, but very critical would be to see that whether how much of the diesel price increase has been factored into this particular calculation. If the diesel index has not moved and still we are getting 6.8, then market could take it negatively. If the entire diesel price hike, including the bulk diesel price hike, is already factored into the 6.8 number, then I would think that market would not be reacting too negatively to it.
Okay, we don't really have all of the internal, Samaran, but as you pointed out, it would certainly be interesting to see the fuel article inflation. We do have, however, the primary articles inflation that has come in at 9.7% this time around. So that has been an improvement from last year, last month, at 10.3%, and also a little better than what we were expecting at 10.2%. We've also got Amisha Vora, Joint Managing Director at Prabhudas Liradhar, joining in on the show. Amisha, hi, thanks for being with us. Well, we do have the inflation numbers, which have come in at 6.8%. It's higher than what everyone was expecting. How disappointed do you think the markets are likely to be?
I think our own number was around 6.84, maybe on the higher side of the market expectation. But 6.8 to me looks okay, particularly also since you added one more thing, that the primary article inflation is about closer to 9 point something instead of 10 point something, and we had projected something around 11. So I think that the fuel side would have added a lot more to reach this number. And of course the important one also would be the manufacturing side, where we are expecting that the muted trend of around 5% to continue. So if that is the case, I feel that probably markets would not take it too negatively.
We've got with us Dr. C. Rangarajan, the Chairman of the Prime Minister's Economic Advisory Council, now joining in on the phone line. Thanks very much for being with us, Dr. Rangarajan. How would you read into the 6.8% number for the inflation this time around? Because what seems to be particularly worrying is the fuel component at 10.4%.
Well, what is more significant is the decline in the non-food manufacturing inflation. The headline inflation has turned out to be slightly higher than what one had expected. I had thought that the headline inflation would remain more or less at last month's level or slightly lower, but it turned out to be slightly higher. But certainly the non-food manufacturing inflation has come below 4%, which is a very welcome sign and which will be an important indicator as far as monetary authorities are concerned.
Dr. Rangarajan, do you see a fall in the core inflation numbers increasing the chances of a rate cut from the Reserve Bank next week?
I think it gives greater space to the monetary authorities. Since the core inflation has been identified as the result of demand pressures, and since containing demand pressures is the objective of monetary authorities, the reduction in the non-food manufacturing inflation certainly gives, in my view, a greater space for monetary authorities to act.
And do you think that, this kind of a number, 6.8%, is perhaps just a one-off? Do you see the inflation numbers now cooling off going forward? What's the kind of trajectory that you would map?
Well, we had expected that perhaps that by the end of March, we would be somewhere around 6.7, 6.6%, and even after making some adjustments in the administered prices, we can see the inflation rate hovering between 6 and 6.5% during the next fiscal.
Given now, Dr. Rangarajan, that, the economic growth also carries a high political premium, that the Reserve Bank would perhaps find it a little difficult to just cut rates to stop the economy from overheating, and that because the last round of a cut by the RBI, it did result in taming inflation, but the impact on growth was fairly significant. What's your view?
I think the impact of any reduction in interest rate or adjustment in interest rate on growth takes a time. It is not something that will be seen immediately. Therefore, one has to wait. And after all, growth and investment are influenced by a variety of factors, and interest rate is one among them. But I do believe that in conjunction with the various measures that have been announced by the government in recent time, an adjustment in interest rate will make a good package, and therefore it can push investment and growth.
All right, and what is your view on the GDP growth for FY14? Will we see a gradual recovery?
I think so. We should see the full impact of the various measures taken before the budget and in the budget to be felt during the fiscal. Therefore, I expect the growth rate to be about 1 to 1.5% higher than the current year. Therefore, this will give us a growth rate between 6 and 6.5% in the fiscal 14.